Good evening, everybody. Welcome to your Go Markets in a Circle session for tonight. We're going to do a critical market update. We should do one of these at least once a month, just to check in where markets are and what the overriding or underpinning, depending on which way you want to term it, headwinds and tailwinds are, and what this is meaning for markets, what could be coming next, and of course, what this means to you practically. Good evening, Neil. Hi, Michael. I trust you can hear and see me okay. So what we normally do on these sessions is we'll just do like we do on the live updates a little bit, just flick back over the news again a little bit and have a look at some charts for right now. And then we'll talk about what's going on, what could be coming up, and as we go, we'll check in on some of the charts as well. Hi, Leanne. And g'day, Shane. G'day, Michael. Hi, Wayne. Thank you. Okay, let's get rocking and rolling. And obviously, this important message that this is delivered for educational purposes only by myself. Hi, Alison. And my opinions, my views, not that of Go Markets, particularly in a session like this where I'm trying to pick things apart and put them back together in a way that might be slightly more digestible and comprehensive that you may get elsewhere. So that's what it's all about. So do your own due diligence on anything you hear, and of course, make sure that you do what you need to do in terms of your trading plan and managing risk. And we are in a medium to high risk environment, I would suggest. We stated that, put that in the Trader IQ. I'm going to do that on a daily basis now in the Trader IQ chat room and talk about it in the live update. I've got a little thing I'm going to use. Let me know if you've got no sound, guys. Somebody's just dropped me a message saying they've got no sound. Yep, thank you. Cheers, Sonia. Right, I'll send him that message brightly. Okay, all good. Right, thank you very much, Alison Leanne. Good to see you here later. Hi, Jean-Francois, and g'day, Chris. Okay, right. Okay, let's 3 key questions, and we're looking at this sort of stuff. Is hi, Colin. Good to see you here, buddy. Is what's happening now? What could happen next? And of course, what does this mean to my trading? And obviously, what we're looking at is what the market risks are, and potentially the opportunities, of course, because we can trade long or short. But it is critical in achieving ongoing trading success. I heard something the other day that was said on a Go webinar by certainly not myself, but a recent speaker that suggested you should never short stocks or indices, and what a crock is my response to that. If you've shorted the indices or stocks on many occasions, particularly over the last 3 months, you would have done very well. There's a time and a place for shorting, as there is for going long. And even though, and I profess this profoundly, is that most of my trades are long, that's due to my particular inadequacies. Although results aren't any different going short than they are long, that's just what I'm used to, what I feel like. So to make a categorical statement like that is just rubbish. I should be careful what I say, really, shouldn't I? But it is nonsense. I don't want anybody to mislead you. It's my responsibility as a teacher to tell you how it is. And those of you who have known me long enough on these sessions now will know that I try to do that but they are my opinions, okay? So I agree, Colin, some of the best trades are short. Anyway, the news now, obviously the US markets lost ground overnight. We'll talk about the Fed in a little more detail there. I'm going to talk about 4 issues in more detail. I'm going to talk about the Fed, I'm going to talk about oil, I'm going to talk about what's happening in the Ukraine, and maybe even talk about inflation a little bit as well. So there's 4 key issues I'm going to talk about, because those are the major headwinds, and at this stage they're all 4 in sort of operating together. It's just one seems to be the lead story of the week and then diminishes, another one takes over, but all of these 4 are playing on market minds at the moment. So the fact that we're doing as well as we have over the last 3 weeks is somewhat remarkable, considering the headwinds that we've been subjected to. So it was the Fed. It was a couple of the US Fed members that actually sort of were having speeches. Usually the Fed is made up from chairmen from, if you like, mini Feds. You'll have heard me talk about Bullard often who's a notorious hawk. He's the St. Louis Fed chairman. And so all of these Fed chairmen come together and meet as the Fed as a whole and make interest rate decisions and policy statements and things. Talk about what QT is later and all that sort of stuff, so don't worry about that for right now, but the market got spooked by that. US futures were trading mildly negative in early trading and really have got worse as the days progressed, and now I think they're as bad as they've been for most of the session subsequent to European Open. Again, we sort of talked about that earlier on today in terms of that may very well happen, and just checking in with that. Yeah, it is actually the worst of the session. We've dropped fairly significantly. The VIX continues to creep higher throughout the day. The Nikkei underperformed this morning, but all Asian markets essentially followed that weaker US lead, and Europe is lower. And US dollar index is broken to the upside on bond yield movement and the Fed comments. Gold's hovering around 1925 still. Oil moved lower again below 110, but looks as though it's starting to creep up again. Cryptos are not going anywhere. They moved up a teeny tiny bit since this morning, but nothing significant. They still look as though they're heading back towards a key level to the downside. Chinese services PMI were very weak this morning. German factory orders, I think they're out already. We'll have a look. Don't think the Euro PPI is out, and we've got the FOMC minutes, which is really a minute of the Fed meeting, which produced that first interest rate hike 4 years. The markets will pick apart those minutes and see if there's anything that hasn't been already telegraphed. I suspect it won't be. Thanks, Wayne. I just need to adjust it a little bit. Sometimes it just flows off the bottom. But anyway, let's have a look at some stuff and see what we can find. If we just look at the futures, you can see there. These are only mildly negative when we met early this afternoon, and you can see they've diminished even further. You can see that oil has sort of crept up a little bit. Gold has crept up a teeny tiny bit, but it's still sort of in between it's really being between 1925 and 1935 for all of the day. The yen continues to look weak, but not as weak as it was. The Swiss franc seems to have dropped off a wee bit. And as we said, European markets are looking a little scary. That's how Asia finished. And if we look at really across the board selling on all of the major euro indices, DAX and CAC 40 underperforming. FTSE's doing slightly better. But that's really where we're at, and of course what that does is we've got a little bit of a rolling thing going on here. If we get Asia down, that usually sends Europe down, which usually sends the US down, unless there's a little bit of a spanner in the works. And is that likely to come from economic data? Well, possibly not. You can see the German factory orders are actually really quite bad month on month. It was expected to drop from last month, but it dropped and also moved further down than was expected. Factory orders are really quite important, and you can see there we've been on a gradual sort of move down over the last few months. PPI data is out, and that's actually good news. So the producer price index is like business inflation. It says, hey, look, this is, you can see how much this has dropped from last month. That's quite a spectacular drop, actually. We'll check in on what's happening with the euro, because that's really very positive. Actually may not be positive for the euro, because obviously high inflation numbers are likely to make interest rate rises more likely. So that's good for euro stocks, bad for euro currency, theoretically. But it's the FOMC minutes, which is a major act of the day. Is it a military production order metric, and is it significant? I'm not sure, though it is. But certainly if you look at some of the stocks which are involved in conflict, they've done very well. So some of the General Dynamics, I think they're called, Lockheed did very well. We put one up this morning as well. But certainly those stocks have been in a pretty good place. Tomorrow, tomorrow's probably going to be dictated to some degree by what happens with the further speeches from the Fed, including Fed Bullard, but more so possibly the jobs reports. He's likely to go like hell for leather. So anyway, so what does all this mean in terms of charts and stuff? Well, here's the S&P 500. You can see, if we just put it on a 30-minute chart, you can see how this has gradually got worse in the day. Seemed to be picking up until European Open, then we just dropped completely. So not a happy place to be, really. You can see there we're pulling back down to this. We're back through 40. We're challenging 4,500 right now, which is, that's 4,500. That's quite an important level. Don't know why I didn't have that on there, but you can see there, if I just make sure, there we go. So you can see there, sort of support here, resistance here, a bit of resistance there, some support there. So this 4,500 is quite important, and we're actually looking to breach that. If we do get a breakthrough, that's some further selling, we could see it down to 4,400. But context is important. We're still, as I said, we still had a fairly remarkable month, and we're still doing pretty well for the month on the S&P 500, in that we're up nearly 8%. For the quarter, we're actually in negative territory. You can see this is where we started the year, so we're down. We ended the quarter in negative territory, so down around about 3.5%, which is as bad as it's been for 4 years. I think that's the worst quarter for 4 years. And that was despite good earnings and things like that. So here's the NASDAQ. This is looking, we talked about it looking double toppy earlier on today, and it's continued with that really. We're now through 15,000 with some interest, and we're hanging. We're actually tackling the 200 MA now on the daily chart. This is looking very bullish. Should come down and test 14,500. I would say is the next level to get interested in, which is sort of around here. There we go. 14,500, about that point there. I can see easily dropping to that point there from here. So if you've been short, you would have picked up 100x points in the last couple of sessions. Now, was this predictable? Was this predictable in any way? Well, if we put the MACD on this, and I've talked about this before, but let's just put the MACD on the NASDAQ. Was it predictable? Well, yes, it was. This is what I've talked about before. If you look at the index, and once you see that signal line going over the histogram, that's an important metric in terms of a potential turnover. What it's saying is the momentum is gone that we had here, and we're now momentum is being lost at a fairly tremendous rate. So we could be in for a move down with some significance. Last time this happened was here, and we ended up all the way down here eventually. So just be aware that technically the market is looking as though it might be done for now. Certainly in the last two sessions, the sentiment appears to be pretty negative, but I'm still, if I had to plant my flag, I'd say that was possibly the top for the foreseeable. So that 15,230, and I would actually say that the bottom of this may be 14,300. So I see possibly a range here at worst that we might find ourselves in for the next couple of months or so. But at this stage, I'm hanging on to a range that's between these two, 14,500 and 15,300. Now, quick look at some other things, and we'll come back to oil. But you can see oil there is up for the day. Looking to retest 110 on this Brent contract. Looks very well supported around 108, and certainly extraordinarily well supported at $100. Is the US dollar index. That's come off a little bit since early early doors this morning or this afternoon, but still very bullish on that. And the VIX is looking more and more bullish, could make our way back up to 25. That's a key level on the VIX. Gold really hasn't moved very much since we last met, 1927. Cryptos coming down. So if you look at some of the major currencies, euro is very interesting. So that PPI number, I think, possibly sent the market up. I'm guessing that's possibly what happened here. Sorry, PPI sent the number down there, but this was starting to shift up and with some significance. So this has now created a really nice point to the upside and a fairly nice point to the downside. So we've got 108.87 to the downside on the hourly chart. We've got 109.24 on the upside. So around about 50 pips from top to bottom. And so we could see, if we're going to break over this level at any stage, we could see a move up around about 30 pips there. That's not looking too bad. Aussie yen on the daily chart still looks great. It still hasn't broken. Remember, when we talk about trend continuation, we like the idea of it breaking a pivot high. That's the pivot high we're keeping an eye on, particularly as it's had a couple of shots over the last couple of days. This looked as though it might be ready to rock and roll, but didn't. And you can see there, sort of had a test about 3 hours ago when you're up, and we just got this going on. We are higher in Asia than we were at the start, but that's due to yen weakness rather than Aussie dollar strength. A GB pound Japanese yen. Now, when we did talk about this, we said that there was a potential scalp trade to be had if it broke this level here at around about 161.13 to 14, I think. And sure enough, it did that. But again, we sort of said, well, look, maybe for right now, we're restricted to around about 20 pips. And that's what it's done. This is the major level we're talking about today on the 4-hourly chart. You can see that clearly on the hourly. Depends what the feeling is about the yen. The feeling about the yen at the moment is not good. A couple of things have upset markets. Firstly, there was the Bank of Japan potentially indulging in some QE by buying some 10-year bonds, and then we've got them coming out and suggesting that 130 is on the Japanese USD is a scary level, or USD Japanese yen, should I say. It's currently at 124. That created a little bit of a market blip because that suggests some sort of central bank intervention if that happens. But the fact that it's $6 away from that at the minute means that that's not imminent. Lots of upside, 600 pips of upside, in fact, to be done with that, or about another 4%. So we're way off that yet. So interesting to see what happens next. If we look at the euro yen, we saw a little bit of euro strength there, so we've got a nice level here. The thing about the euro yen I don't really like is this nonsense here. We look as though we're struggling a little bit. We didn't have much of a look at the Swiss franc apart from against the GB, apart from against the yen, but we've had a really nice pickup in this. And if we look at the daily chart, most certainly a bounce. If we put it on a line chart just so we can find these lines a little clearer, technically possibly a move up to around about that 122.54 level. That's a chunk of pips from where we are now, and we would suggest that this level here is really quite important at around about 120, just over 122, one of those key levels again. And so this is now looking sort of interesting. So we had a break through that and then a retest. We're having a retest of this 122 level at this stage. But I quite like this. I quite like the potential there of a 30-pip move. If we look at Euro Swissy, let's just get all the data. That looks as though it's got an even more critical level at around about 102. Not surprisingly, 102 is dead. A break of 102, and we've possibly got, what's that, about another 30 pips on the upside as well. So that could be one to watch. Also, if the GB pound gets any strength, here's the GB pound Kiwi, which has had a really interesting day at the office. Very, very choppy over the last few hours, as you can see there. I can't remember what our chart of the day was this morning, but we could see a move back up to Now it's stuck at 188. Looks as though it's rejected a further move down there. We could see another 30 pip move up there. I think FX is going to be a really difficult one to play today for the rest of the day. So I'm suggesting FX with caution, but it's difficult. Certainly Euro USD looks as though it might be worth a look, and also Euro Yen, perhaps Euro Yen. If it breaks that pivot high up to around about 135.55, maybe, with some jittery stuff going on. We'll come back to stocks in a little while, but I just wanted to just talk a little bit more about stuff. And now there's a little bit of a change with things in that normally markets respond primarily to data and to any corporate information. And then sometimes they go completely the other way and become headline-driven markets, and that's exactly what happened when the Ukraine conflict kicked off, and Putin and all his evil minions decided that Ukraine was an easy target and created the atrocities that we're seeing right now. So of course, when that first broke, it was very headline-driven. Every headline that came across was impacting markets. Then, of course, that came off a little bit. But now, as I said before, there are 3 or 4 headwinds, and each month seems to pop up another one as the major story. The problem with headline-driven markets is that we haven't got an indication of timing. Now, it is less so with some of the things that we're seeing simply because we know when the Fed are going to speak. We know. So although it's not new data, although it's sort of fundamental information and opinion that's driving markets, at least it's more predictable than that. Every couple of hours, something else seems to come out, and every another hour, something else seems to come out. So it's less headline driven than it was, but still, the problem with headline driven markets is, as I've said before, is not only the event itself, but also the implications and when there's uncertainty about the end game. You know my thoughts on pricing of assets. I think it's all questionable at the best of times, and certainly in any situation where there's potentially big moves, then it's those key levels we're looking at, and often those key levels are associated with round numbers. This is normally important, but in situations like this, the market's got nothing else to hang its hat on. So, oh my God, the Fed's gonna be more aggressive than we thought. Therefore, let's take it down to X level, is what happens in practice. And that's why knowing your key levels are so vitally important in terms of price action. So what's going on? So what are the major things going on? Well, let's look at them and try and pick what it means and what the implications are and how serious it actually is. So let's start off by the Fed tweets that I referenced earlier. Now, what we've had really since the beginning of the pandemic is central banks doing absolutely everything to make sure that we don't hit a global financial crisis again. Okay, that's really what the objective has been, and there's always blooming experts that they rock onto the TV who say, well, look, the Fed shouldn't have done this, and the Fed shouldn't have done that. The Fed actually did an okay job. In fact, most central banks achieved their objective and make sure that the whole world didn't go into depression because of the pandemic. It was through necessity. Now, of course, you can sort of nitpick and say, well, maybe we should have done that, maybe we shouldn't have done this. But really, what does that serve, apart from trying to appear to be a bit of a smart ass on financial media? But secondly, it's a situation which was unprecedented, and the overall objectives was achieved. And we always knew there was a price to pay. We always knew we wouldn't get zero interest rates forever. Okay, so ultimately, eventually, central banks had to start raising interest rates again. And the fact that they haven't yet, up until, in the US case, up until March, was the source of angst amongst many fund managers who were getting twitchy that they'd missed out on some profits that their clients are going to hang them with later in the year. So there was a global move to make sure everything was okay, and like it or not, objective achieved. And there were two strategies used. So there was rapid decreases in interest rates and what's termed quantitative easing, where what happens is the Federal Reserve, and this is tactics used by the Fed. There was obviously a lot of money put in by governments as well on top. This was nothing to do with the Fed. These sort of stimulus packages weren't Fed orientated. The Fed isn't in a position to do that. The Fed's two mechanisms are interest rate decreases and making sure there's enough liquidity in capital markets. And it does that through a program of quantitative easing, which is usually where they buy assets to put money in the system. Now, unprecedented levels of around about $9 trillion of assets. Now, normally, just to put this into context, pre-GFC, I think it was down at 1 billion. Now it's 9 billion. So ultimately, that's not a good thing. You've got all these assets on the Fed's bank balance, and ultimately, markets don't like that very much. It's not seen as being good economic policy, even though it really doesn't impact on global bonds very much at all. The reality is they had to do that to make sure there wasn't a collapse of capital markets. Interest rate decreases are obvious why. They wanted to stimulate the economy as much as they could to allow some recovery, and of course, that happened. We've had a far better recovery from the pandemic than we ever thought was possible at the beginning. And evidence of this undoing, this starting to undo this, we had the Fed stopping their QE. They're not buying US treasuries anymore. They tapered that down from November through to March and aren't doing it anymore. And so the reverse is going to happen. We've got to undo what's been done as the economic situation has improved. And the economic situation has improved significantly. We've got jobs data that's better than pre-pandemic at this stage. Now, of course, all central banks are doing this, with the exception of Russia, of course, who are on the receiving end of what I still think are tame sanctions. But we're starting to see interest rate rises and what's called quantitative tightening, which is the opposite of quantitative easing across the board. Obviously, the US Fed is the major influence on global markets simply because it's the leading economy. As I said, quicker than expected global recovery. Now, so the Fed has already telegraphed it raised its rate by 0.25. That should have been by, not A, by 0.25% in March, although there was some, including the federal chair, federal member Bullard, who I've spoken about before. So the action that was telegraphed in March, and they suggested that potentially six additional interest rate rises due in 2022, with the potential for 2 more in 2023. None of that was a surprise to markets because it was already priced in to some degree, but the unknown at this stage is how aggressive that will be, okay? And one of the things that, and on top of that, there's quantitative tightening, where we're going to move towards reducing the balance sheet. So like $9 trillion of assets, some of those will be treasuries which will expire. Some of that may be sold back onto the markets. Not sure how they'll actually do this, or the rate at which they'll do this. There's no clear roadmap for how they're going to do it. And it's the scale of this. They haven't had to get this amount of stuff off the balance sheets ever. So, so markets are a bit perplexed and uncertain about what, A, how this is going to happen, B, how it might upset markets. So that's really where it's at. Now, part of the reason things got twitchy last night was that you have got members of the Fed who are quite hawkish, who want to move things quicker, want to tighten quicker, want to raise interest rates by 0.5% at a time rather than 0.25%, and then you've got others who are quite dovish, who says, like, let's just take it easy. Yes, of course, we need to do this, but let's do it according to data and let's do it slowly, particularly with some of the other things that are going on I'll talk about in a moment. So, but one of the reasons the market got twitched is a couple of these guys who are usually in, actually one of them's a girl, a couple of these people that are usually in the dovish camp were actually the ones who were quite aggressive last night, and that was the surprise, I think, to this. So these Fed minutes tonight will be really important, plus what happens when they next meet. You'll also heard me reference the yield curve. Now, what that means is that a bond yield is the there are all sorts of treasuries, and the bond yield is the percentage return on that bond per annum. Okay, so they hit, because interest rates, and they're based on interest rates to a large degree, and of course they're traded, and it's so there's some degree of a lot of degree of speculation. So we've got, to give you two examples, we've got the 2-year and the 10-year US bond yield. These are looked at quite significantly. Okay, and normally you would expect the prospect of, or it would be more likely to have interest rates higher in 10 years than it would be in 2 years, particularly in the state that we've been at. So normally the yield will be higher, because the yields are always higher if it's a longer term than on the 10-year. And when the reverse is the case, this is termed curve inversion. And we've got a little bit of that at the moment. Actually, they're pretty close at the moment, but it looks as though it is in the process of inverting. We saw some evidence of that last night. And you think, well, whatever. Okay, but the markets get really upset by this because really this has been seen historically as a precursor to what's termed recession, which is 2 successive quarters of negative GDP. It's nowhere near this, okay? And is the first thing to say. Second thing to say is that this has not always been the case. Some economists, I was doing a bit of digging around today and just sort of seeing, well, how often does this happen? And I reckon it happened, possibly some sort of leading guys on this suggested maybe 60% of the time, others as low as 40% chance of recession within the next 12 months. So it's by no means a certainty, but it's just another thing to twitch markets out. GDP isn't showing this, and so we're not interested. But whilst it's market chatter, and it's another reason why markets may not bounce quite as well as we thought, unless the Fed gets a little more dovish. I'm not sure that's going to be the case. We referenced in our last critical update, which we did shortly after the Ukrainian conflict, or Russian invasion, whichever you want to call it, or Putin's war, was the price of oil. That's really still an issue. Central governments across the Eurozone, including all the NATO, are really struggling with should we buy Russian energy? And of course, this impacts mostly on Europe. So you see here that Germany and Italy by far and away the biggest users of this. So this isn't it's an interesting balance. Okay, now just to put it into context again, before the Ukrainian conflict, let's just have a look at an oil chart, because it's not all down to the Ukraine. It's nonsense to actually suggest that it is. So if the Ukrainian conflict happened mid-Feb, okay, that's when it really sort of ramped up. We're a couple of months into it now. You can see that oil was still actually rampaging up and had moved up. If we look at where it had been since September through to mid-February, it was already up nearly 30%. And the reason for this is quite simple, is that OPEC decided to switch off the taps, or decided not to turn on the taps. Now, what happened is that when there was a global slowdown associated with the pandemic, OPEC wanted to reduce the supply that was in the system, and what that did is it just helped because there was no demand there. People were all locked down; they weren't driving anywhere. There was no flights anywhere. So oil actually in the post-pandemic dropped all the way down to $20. Okay, so if we look at since even pre-pandemic levels, it was only at 60. So what happened is the OPEC countries said, we got so absolutely battered in 2020, we're not in a rush actually to turn the taps back on. And so obviously, like any supply and demand thing, as demand increased, supply wasn't being increased accordingly, and hence oil rose. So oil was already heading and nearly at $100 a barrel. So it's not all to do with the Ukraine. So don't be kidded that that's the case. Now, when it was going really gangbusters, we had all sorts of wild and wonderful claims. We had Russia claiming that oil would go up to $300. I wonder why they suggested that. And of course, the markets responded to that. You got sort of guys. Then you got guys suggesting that, well, look, maybe not 300, but maybe 170. So that's what some economists were saying in the West, some non-Russian sort of opinion. So we are at highs not seen since 2008. We've got some commitments not to buy Russian oil and gas and coal from the US, but so what? They're not even on this list, okay, of gas exports. The UK has followed suit, but it's really more difficult for mainland Europe. And of course, this has come at it depends how you sort of read it. In terms of this move from into sort of more environmentally friendly or decarbonisation types of fuel, obviously that is starting to gather some momentum. So in terms of timing, this is just sucks because we're not there yet, or not nearly there yet. My suspicion is, and I think I intimated this last time, is that in the same way that we saw a lot of tech accelerating its development at the pandemic simply through necessity, I think we're going to see the same in terms of renewable energy sources. So just watch this space for that one, and I think that might be a good place, make a note of that, to find a good place to put that. So I'm on a mission. One of my missions for this next week is to find that place. That's that $300 oil price prediction. Analyst up to 170. Now, this was a knee-jerk response to what was happening right then, and the conflict had just started, and it doesn't take into account any global slowdown, of course. And we're seeing that. We're seeing China in a COVID crisis at the moment. So we've got petrol at really high levels, off their highs, thankfully, but the impact of it is seen to be significant on the pocket of the consumer. It's like an extra tax. In terms of its impact on a specific household, I'm not actually sure it's massive. It feels massive because of where it was in the not too distant past. But if you're using work it out for yourself and you decide whether it's important, how important it is. If you've got a 25% increase in the price of petrol and you use 50 litres of petrol a week, what difference does that make to your actual pocket? Somebody works out, it was clever. Interesting, Alan. Keep current nuclear and coal going for short term. Actually, that's very true, Ed. So you get in $12.50. Thanks, Alison. So that's at $12.50 a week. It's not exactly a shirt off the back figure. Okay. Absolutely. People are stepping up and saying people are saying that or people are starting to put together some things like yeah, obviously you're right, Colin Twiggy, moving to supply Germans gas. Thanks for the links. I might post them in. I'm just trying to work out how I can do that. Now there was another Ed's given a little chat thing on on where to get the yield curve. 2 to 30 is pretty flat. Yeah, notice that as well. There was something else I saw that suggested I think it was 6 month and 3 year was a better indicator than the 2 to 10 year. The 2 to 10 year is what it's all about. And I do think coal is a good place to be, and it's one of the stocks that I'll probably recommend. Jean-Francois has legitimately said, and that was my next point, although the impact on the consumer is not massive, the impact on business is though, okay? From 2 points of view. First of all, of course, those who directly use a lot of fuel, though most airlines are hedged, it'd be interesting to know how well they're hedged, but transport companies are really going to be under pressure. So those sectors, anything in the transport sector is directly going to be impacted. And of course, the costs to business, if the cost of transportation goes up, the cost of that will be passed on to the business, which ultimately may be passed on to the consumer. And this is one of the key points about inflation, is that ties into all of this supply chain issue that we've got going on at the moment, which are normally inflation. Okay, normally inflation occurs because the economy is really strong. So what happens is people do well, businesses do well, people spend lots of money, employment drops. So what happens is everybody's got a job, and in fact, there's such competition. There's no competition for jobs. So the emphasis is with a business to put the wages up to essentially attract somebody from one company into their company. So you get these wage pressures rising. So people's wages increase, and that's increases more spending. That's the standard way that inflation occurs. This inflation is not, although there might be a little bit of that going on, this inflation is of a very different type, in that it is exactly what's been described here. It's that cost in commodities, it's supply chain issues. It's trying to get people into work because they've been quite happy sitting on the sidelines, not working for a little while. So it's a very different type of inflation, or a very different source of inflationary pressure than is the norm. We look at any soft commodity and it's through the roof. And that's obviously been contributed to things like wheat. Of course, Ukraine is the 5th largest wheat exporter on the planet. You get that taken away, and that has an impact. So there's all sorts of issues going on here. So it's not all about oil. Virtually none. I don't think there's any gas comes from Russia into Australia, or a negligible amount. So it's not all about oil. The major impact is going to be on the European economy. If they want to really smash Russia from an economic point of view, then they've got to find alternative ways of oil. Otherwise, they're just giving them. I saw a remarkable, something like $400 million a day, something quite extraordinary. It may even be higher than that. Goes into Russia's economy because of the gas that's bought from the euro, from the main euro countries. Anyway, they've put out a target to reduce 2/3. I don't think oil's going to go down much below 100, but simply because, and if it does, it's because the global economies are in trouble. That's the only reason I see it dropping below 100 until OPEC switches taps on. Because that's the major impact. It's not the conflict, it's OPEC being mean and wanting lots of cash for their oil. But it will. I mean, this is a catalyst for finding alternative forms of energy. Okay, I presented this last time. I just want to go back on this. Much depends on the state of Putin of what the end game is in Ukraine. I don't think Putin will withdraw, full stop, end of story. Unless there's a major shock. i.e. we get some intervention from outside, decimates the Russian troops, and therefore and the conflict escalates to such a degree, and it's so decimating to more than just the Ukraine. That tends to be what happens in wars. And then ultimately people are forced almost to come around the table. There is no incentive at all for Putin at this stage, politically, to back down. None. Okay, and whatever the outcome of this is likely to be a new normal. He's got it locked up. He's got it locked up. He's got his country's media locked up. He's got every time he knows very well that every time he mentions the word nuclear, that NATO will shake in the boots about it potentially escalating to World War III. So he's got that can. It just depends what has got to happen for Ukraine to get any more help. My guess is that isn't going to happen. So here's the scenarios. Russian invasion is protracted, but ultimately it falls under Russian power and a puppet regime is installed. I think the Ukrainians have probably reduced the likelihood of that happening. I think I gave that. I'm trying to remember the percentages I gave for this. Negotiated settlement where Russia retains control of a portion of Ukraine and withdraws. At best, that southwest corridor, which is why Mariupol is under such extraordinary pressure and why they've gone back to the Donbass region, is that would create a bridge between Russia and Crimea, which they took in 2014. So there is a suggestion out there that part of a peace negotiation might be that you have this bit of Ukraine and we'll have the rest and be sovereign, and we promise not to join NATO. So that is certainly something that is part of the deal, but I think the likelihood of that has probably changed over the last week when they've seen what's happened with Russian troops withdrawing and what they've found. I don't think there's anything going to come of this war criminal thing. Third scenario is a rise up by the Russian people on casualties. This is now near 9K estimated. It was 2.5 to 4 when we last talked about this. And somebody finds a bullet, puts it in Putin's forehead. If you look at it on the TV, it just looks so welcoming of such a thing. I'm sorry, I shouldn't say things like that. Apparently the man's obsessed with what happened to Colonel Gaddafi. Apparently he's really obsessed with that for a long time. The reality is that he's got the Russian media absolutely tied up. He's got I think something like 45,000 people are now locked up for even mentioning no war, still not being called a war on Russian media. He's got it sewn up, and there's this fake news story going around, which obviously is a Trumpism. His hero, or rather, was Putin Trump's hero? He is, after all, a genius, said Trump in January. Anyway, there's a risk of up to 15 years imprisonment for sharing fake information. And as I said, it's much more than, it's well over 45,000. Just having a quick look at questions and seeing where we're at and comments. Yeah, I agreed, Ed. That slice down the middle scenario is potentially one, but I think the will to do that is possibly changing. Although I still think of these three scenarios. Oh, sorry, conflict extends beyond Ukraine becomes Russia versus NATO. I used to think it was accidents, but that might cause that. But I think it may be that Russia put something in place that's going to make it. I'm not sure what that is, but it's going to make it very compelling for NATO to get more directly involved than it has been doing. So it's really difficult in terms of the end game. Last time we met, I would have put number 2 at the top. I'm not sure that's the case. I'm really not sure that's the case. It's a really difficult call. So what's this space really? It's sort of sad that it's come off their headlines a little bit in terms of markets, because but maybe it's just that markets have got used to the prospect of living or of the implications, starting to get used to the sanctions and the implications of those, and feeling that they're manageable in their current state. Okay, other headwinds, tailwinds, inflation remains an issue. I've talked about most of this. The Chinese COVID situation has contributed to that. We're already in a dodgy supply issue. China's going to make it worse. Risk of stagflation is real. That's inflation with no growth, but not shown yet in the data. And we have got US earnings season potentially starting in 2 weeks, which will save the day. Because remember, again, context is really important. These are still historically low interest rate environment. So it's an interesting point. Ed's made some great points about his potential end games, and I think that slice down the middle, yeah, with the east under Russian control and the west within EU. I think that, to me, that's still the most likely scenario, but I'm really not sure that the Ukrainians will tolerate that at this stage. Wayne suggested that, or Wayne's raised the possibility that, what about if China goes to war over Taiwan? Okay, and good question, Alan. And there is a suggestion that the Chinese have not been, they're still adhering to the Putin rhetoric rather than the real deal, and underreporting it because of that. Because that incongruence, if Taiwan ever does become an issue, I don't see that in the near future. So I think earnings season will save the day and keep stock markets up a little bit. So look, I've tried to be balanced about it, but really it all comes down to what can it mean in practical terms. We don't know what the end game will be. We don't know, and that's not just with the conflict. Or we don't know. We don't know the extent or the timing of QT. That's hurting markets a little bit. We don't know whether the sanctions will start showing up in the data. That's an unknown. So there's a real chunk of uncertainty kicking around. We've been in a volatile market since the beginning of the year. That's not going to go away, I suggest. What I think is we might find a range, but it's making accurate judgments about markets even more difficult than they usually are. There is a chance, we saw that, we talked about this before, this was potentially an overshoot. This was potentially an overshoot. Remember, this was a drop in excess from highs of over, it was bear market territory on the NASDAQ, and not far behind on the S&P 500. So the market said this is an overshoot. It's actually worth more than this. We are still, context is we are still in a low rate environment. We're relatively good employment. We've got earnings which have come in okay. Even January was all right. So despite this drop, this was primarily inflation, Fed-driven drop. So this earnings season is going to be critical. So there was an overshoot, but have we done our overshoot and retracement now? So really, when it comes down to, certainly it's very difficult to predict what's going to happen for more than a couple of days. That's still the case. It's probably slightly easier, unless it's about the yen, of course, which has just gone down day after day after day after day. It may be that your approach changes. So you either go very long term, looking for stocks which have a good balance sheet, which invariably perform well, have a relatively inflation-proof. So you're looking for things that are less discretionary and more staples, although arguably a lot of tech is staples these days. It would be interesting to, I can't see Microsoft going away, for example. So that's one approach that might work in this stage, is looking for those stocks that are at relative value, that historically perform and fundamentally have a reason to go up. So that's things like, I've given the PLS example before, where rise in EVs will result in more batteries, which will need more lithium. But of course, the auto industry has been sideways bashed from the absence of titanium, which I think Ukraine is an exporter of as well. Maybe Twiggy should consider that rather than gas. Anyway, so I would suggest that your sort of shorter timeframes on your FX are normally a good place to be, although not today. I think indices are relatively easy to trade on the short term. Share CFDs, lower your expectations in terms of your return, and shares if you're trading in the short term. If something goes in your favor for 2 or 3 days, you're almost tempted to rip it off the table, because it's better to lock that in the way markets are, turn it on at a dime. And remember, you can do things like position size lower, etc. Look for things that are having a disparity from the norm, and the yen is a superb example of this. Okay, so the norm would be, if the markets were twitchy, we'd get a flight to safety into the Japanese yen. Although this has hardly been the case, and the Aussie hasn't performed that well. So that's a disparity from the norm. So we look for reasons why that might be the case and potentially take advantage of this. And this technically is actually a good looking chart. I wouldn't trade this on a daily time frame, but I'll be certainly looking for a break of that, because if it breaks 94.31, which does represent a high not seen since 2014, if it breaks it on the daily chart, it's also going to show up as a key level on the 4-hourly, on the hourly, on the 30-minute. It's going to show across right across all those time frames, and so you're going to get lots of traders getting very excited, irrespective of time frames. Lots of VAs kicking in. That's a good place to be. Against the yen is a great place to be for right now. Elon Musk tweets can be your indicator. Absolutely, Ed. For those of you who didn't attend the session, I did a couple of days, the live update session at lunchtime. This is what happened to Twitter when he decided he was going to buy a chunk of Twitter and release that information pre-market. So it actually ended up 27%, but it was up 25% in pre-market. Don't you just wish you were? So we actually talked about Twitter has been a chart of the day here. I didn't get into it, but you would have put your stop somewhere else, sort of underneath this 38.79. And if you had done, wow, okay, that would be one of those market gifts. You take something out of the market and go on a really nice holiday somewhere. Anyway, so that's Twitter, and the Elon Musk reference is a good one, but good call, because he does seem to have a little. Ian doesn't invest small, does he? So when he goes for it, with his billions. Right. I recognize the assets are a flight to safety, but also those are most vulnerable or a beneficiary of particular events. So fertilizer companies looking great. Give me some examples of fertilizer companies, and we'll have a look at a chart. Just type them in. I've talked about a couple along the way. Oops. Soft commodities still looking good. We know soft commodities are not going to go away. We look at soft commodity stocks. We look at DBA, the agricultural ETF in the US, and this is still going up. It's on a little bit of a pause, but if we look at where it was at the beginning of the year, we are up nearly 12.5%. That's going to go up. Intertech, Incitec. What's the ticker code? IPL. Of course it is. Nice move since Jan. 20%. You too, Anthony. Just trying to think of other examples off the top of my head. New Farm. New Farm are sort of in that area, aren't they? Let's go. I've been talking about New Farm for a little while. They're generally in sort of agricultural chemicals, but I'm assuming fertilizer is part of that deal. So they've had a pretty good run. A little pullback over the last couple of days. This was our chart of the day down here somewhere. Just a little pullback for right now. So that's what I mean about think about what the maybe the beneficiaries of where we are now. What's the food ETF ticker code? Ed, do you know it off the top of your head? Oh, ticker is food. Yeah, some of these. I don't think this is on MT5, but we can have a look out, obviously outside of MT5. Okay, let's. Is that NYSE? Oh, let's have a look at, actually, I didn't think of some of these food stores. Let's have a look at TSN. Tyson Foods in the US. Not particularly well, but on a little bit of a roll at the moment, which is interesting. That's actually not a bad chart at all. Let's have that as a little sneaky chart of the day sort of thing. If it breaks 92 and 91.25. Okay, it is the ASX ETF. Sorry, I shouldn't make the assumption. Can you give me a chart? That's interesting. It's an Australian ETF, and it's got deer and all that sort of thing. Deer I've liked for a little while. Yep, that's done really well. Also, be interesting to see what. There's another ETF called Moo, which is another agricultural. Good call, eh? Moo is doing very well, not tradable on MT5 yet, but that's having a storming last 12 months. So yeah, so that's a good example. Let's FSMR. I wonder if we've got those on here. Some of the energy stocks are doing pretty well. Certainly, Alison, who's on this session today, liked AGL. We liked AGL as well. A really nice move on this recently. Looks as though we could be up for a move to. It's not usually an standard move, but certainly looks as though it could be a move up towards about $10 on that. Problems with things like PLS, although I still like it, I would still buy it at this level. We are stuck now under that level there. Pullback on problems in the US auto industry. in terms of getting other parts and stuff. So obviously, if they can't build them, then they're not going to need the batteries and the lithium. Just watch for move over 385. I really like that. Reference Microsoft. I would be very keen on Microsoft over 315, even if it's coming up to earnings. Always absolutely smashes it out of the ballpark, and really, really positive in terms of that. If we look at if you like the US ETFs, you would expect consumer staples to look okay, and indeed they are. Technically, we might get interested if it breaks 77.50. But just look for the ASX equivalent. Also, if we are seeing energy carrying on, then there's things like XOP as well. That's still obviously oil and gas production. If the US are going to contribute a little bit of gas to and a little bit of energy to Europe, then that's probably a good place to be as well. So there's a few to have a wee look at. Interesting. Colin was surprised BLD didn't rise on the need for flood repairs. Not seen yet. But it's a really good idea. So you think something like that, and it's based on something real, then you think, right, okay, what may be a beneficiary of this? Yeah, beach energy we've talked about a lot. I don't like beach energy. I think it's not looking as strong. I think there's other energy stocks which are a better place to be than beach. But undoubtedly it's done okay. Even WPL, which I think again you referenced today, looks stronger than this. There's 34.25. Now the other in terms of the commodity space, apart from soft commodities, you know I like copper. I've been banging on about copper. I've been banging on about copper for years, or not for years, ever since middle of last year. And we've sort of seen it in this slow uptrend, but it is undoubtedly in an upwards trend channel. I still like copper. It's $5. This is its record high that it hit about a month ago. So I can't see any way but up. And of course, then you can look at beneficiaries of that, such as Oz Minerals, such as FCX, which have been waiting on to break $50 in the US. So there's FCX, there's that 52 we talked about before. Oz Minerals has just failed to break its. This was we liked Oz Minerals, but it's just failing to sort of get excited and move back above that 27.30 level. This is a rejection count. This is oversold, I think, really, to be honest, in terms of where it's at now. So any of that sort of stuff would be good long term without a doubt. Also long term, I do like Iluka after the news this week, as I was had a pullback today. This is our chart of the day on this. Did okay on this. Give a little bit away today. This we were already looking at this because this is a fairly strong unit. We're looking at this for a break of that at that 1170. Really like it above the 1170. Was waiting, and then they decided they were gonna go do something like rare earths and add to the mix. And of course, this impacted a little bit on LYC, but good place for them to be, particularly with China not been in a particularly happy place at the moment. Metcash, MTS, I think you were referring to. Again, in the staples sector, yeah, I think they'll do okay. If you want a bank, Macquarie is where I'll put my cash, rather than any of the big banks. Not sure why Mineral Resources keep on doing this, but they just keep on doing this. This has been a regular of ours, a regular look at of ours, but that's an interesting one. You gotta think Woolworths might do okay. So that's looking for the right now, that's looking like a good place to be, and this is one that the temptation would be to jump in if it breaks 37.54, but with the 200 MA, 200 EMA just being there at 37.67, I'd be quite happy to take that and trade it up to around about 38.79, and then see if it pushes through that and closes this gap. So that would be one of my charts of the day for today. And Zero, I like Zero. I think it's a great company. I think this might do well, but we're waiting for a break of 108. So there's some things to have a look at. I wanted to give you some things to do. And remember, you've always got the ultimate sanction of not trading at all. So just to summarize some of the things that I've been saying, copper and related assets I think are going to be good. Good balance sheet, high-performing companies such as Microsoft. Energy is going to be good. Soft commodities are going to be good. Anything in that fertilizer space is going to be okay. And I don't think the JPY still may be under pressure for a little while longer, despite it being risk off traditionally. Until it stops, then the market is saying it's not stopping. That really is the bottom line. I still favour the FTSE as a long index trade, and I've got to favour the XX as well. It's one of the most commodity heavy indices, and if the base metals are going up, if soft commodities are still going up, which we do something of, then I think the ASX is a good bet as well if you want a long-term position. So that's what it all means practically. But the bottom line is that the market will do what the market does, and it's your job to make sure that you do your own due diligence on anything that's a fundamental idea. Look at both sides of the story, as we talked about last night on the ASX share CFD thing, and just do the right thing, have the right plans in place, manage risk well. Don't try to second guess the market. I've done that, and I'll let you know it doesn't work. And look, you've seen sort of some of the results I've put up over the last 18 months, but I still make a complete dog's breakfast of it many times. And the reason for that is I'll let me get in the way of what the market's trying to tell me. So just do the right thing. And finally, of course, whether you're in the market big time or whether you're out of the market a little bit, just remember that this sort of market environment provides a great learning opportunity. We haven't seen volatility like this for a long time. And so look at what's working, look at what's not working, look at how a fundamental story can turn into a potential trading opportunity. Look at those different timeframes and how they're responding to different situations. Look at how headline-driven markets work. As I said, it's less so now, but still an element of that, because this will happen again. And if you can learn a chunk of lessons from this time, it'll not only help you in terms of your general market understanding and your confidence if you manage it well, but by God, it's going to make you in a far, far stronger position the next time it happens. So don't forget that in all of this. And so most importantly, trade safe. We'll see you again sometime for those of you who are rocking and rolling and around about tomorrow lunchtime. Of course, you'll see me then. If you haven't got that link and you want to pop in, if you're available, do it every day. So I see a few of you on here tonight that aren't part of that. It's a really nice session. We'll just do a news and then have a look at some charts. And the link for that is in chat. So, Michael, you're so welcome. Sonia, great to see you here. Likewise, Sean May. It's been great to have you here. Thanks for your contributions. Likewise, Alison, today. We'll see you tomorrow. Wayne, you take care of yourself as always, mate. Lita, great stuff. And Jean-Francois, Leanne, great stuff. Colin, fantastic to see you here. And we'll catch you very soon. Take care. Bye-bye for now. Cheers, Shane.